Hello and welcome to Tracking Trends with me, Nikunj Dalmia, the show on which we debate, ideate and talk about important events which in a sense could really influence your portfolio. Now, what is the moot point this Thursday afternoon at 2 o'clock? Dovish Fed, power risk on rally and rate sensitives are gaining. Financials and real estate stocks are the ones where the uptick is evident, and IT is bouncing back in tandem with what is happening to global technology stocks, especially Nasdaq. So the big question, what we are debating and deliberating on this edition of Tracking Trends is, Fed has pivoted. What it means for India and what are the major factors which are turning positive for Indian equities? Is it time now perhaps to move towards growth denominated stocks, or time now to look at debt? Because the Fed has moved, Reserve Bank of India would also move. Let's set the context here. You may call it an early gift from US Fed, or Santa has come early. This time indeed Santa has come early for Wall Street. The fact that Fed has indicated that they won the war against inflation could really be a fair assessment of what they are indicating for the US economy and what the view on inflation is for 2024. The fact that nobody expected a month ago that interest rates will come down by, well, it's debatable whether it's 3 times or whether it is 2 times, but directionally interest rates are headed down. Now, interest rates for equity investors, they always act like gravity, which means if interest rates they go higher, law of gravity would be at play and valuations come down. When interest rates they move lower, valuations go higher as cash flow they increases. Typically in this cycle, debt always does well, and growth stocks, especially technology and high growth stocks, they tend to outperform. Now I'm going to take this conversation forward and understand the implications of this on your portfolio. Kaustubh Gupta, co-head fixed income group with Aditya Birla Mutual Fund joins us, and let's take the conversation forward. Kaustubh, can you break down for our Indian viewers that how should one read into last night's events and what does that mean for the debt and equity portfolio?
Yeah, thank you, Nikunj, for the time. Look, markets all this while they have been pushed by policymakers that interest rates are likely to remain higher for longer, and which is what market was hoping that yesterday Fed will likely to push back markets against any preemptive easing in financial conditions. But what surprise which came to the market was there was no pushback by Fed in terms of assessment of rate cuts that markets were pricing. As a matter of fact, Fed is saying that they will cut rate 3 times, but market is already pricing in 5 times. Second, incrementally Fed also indicated, or rather Powell also indicated that incremental discussion in the Fed meeting will be with regard to the appropriateness of how tight the conditions are and when they want to dial back on their hawkish stance, which has been the flavor in last 18 months. Third, Fed also indicated that they will not like to wait for core PCE to come at 2% and to some extent experiment with overshooting of financial conditions. In nutshell, Fed clearly came out with a lot more dovish than what markets were pricing in. Now, our understanding is that as of now, what Fed is trying to do is they're trying to go for a big trophy, which is they're trying that US economy actually does a soft landing. There has been reasonable apprehension by the market that whether US Fed can engineer the soft landing. But with this move, given that the inflation is likely to slow down, and the consensus estimate was that for 2024, the global growth will slow down. This move, given that it will lead to some bit of easiness in the financial condition, I think the probability of soft landing has gone up quite substantially, and which is a good news for all risk assets, whether it's bond or it's debt or equity. From emerging market perspective, up till now, emerging markets hands were tied up in the sense that they were, or their policy stance were a lot more focused on ensuring the financial stability, and so is with RBI. But this early pivot by the Fed will give a lot of breathing space to some of the emerging markets to focus back on their local growth inflation dynamic. And in a sense that this is a great news for all emerging markets if Fed actually turns out what markets are already pricing in already, and inflation doesn't misbehave incrementally.
So how do we know that this rate cut will ignite flows back into the market? Is there evidence which says that if interest rates by Fed come down by 50 bips, this is the inflow into emerging markets, and if interest rates cut is 75 bips, the inflow will increase by X percentage? Is there any way in which we can establish that? On paper, what you're saying is perfectly right, but is there evidence to back that?
If you look at drivers, because how the emerging markets they are connected with these developed markets is largely through currency channel, and the driver of currency has been historically valuation, real yield differentials, and real, you can say, the relative differential in productivity growth. Now, valuation wise, US dollar is very expensive. In our assessment, it is at least 15 to 20% more expensive than what trade will or the trade indicators will look about. As a matter of fact, US runs very large current account deficit, and relatively, because emerging markets, they have by and large run very conservative policies, their currencies are much well behaved compared to the historical instances of 2000 and prior. The second thing is that in terms of productivity growth, for sure, given that the base is a lot lower, and there are technological changes, and the productivity ability to do these productive changes are much better in emerging markets. Generally, they leads to and it should lead to a better flows in terms of emerging markets at margin. So both from a valuation perspective and both from an argument of real yield and relative productivity growth perspective, emerging markets stands much better than what otherwise the pivot would not have been done. You have to also look in this context that for the growth to become better, or the rate of growth to become better in emerging markets, the basic catalyst was missing, in the sense that the fiscal policies have been quite conservative, monetary policies have been quite conservative, and currency channel was very, very tight. At margin, that changes in favor of emerging markets, and history suggests that whenever things like this has happened, at least in short to medium term, it has led to very large flows.
So my follow-up question here would be, allow me to interrupt you here. Bond yields in US have come down from 5% to sub 4% in the morning when I checked. Is there a way we can establish that this move, what has been indicated by Fed, is something which is already priced in, or it is not priced out? You know, let's say before the Fed meeting, even I was a bit puzzled that ye kya ho gaya? 100 bips decline out of the blue. Maybe markets saw this was coming.
So look, it is not that out of the blue. Some portion of this market was already pricing in, which is why you will see that over last 45-50 days, USTs which 10-year UST which touched at 5%, it was already trading at closer to 415, 420, because market were looking at this data and they were actually speculating that at some point of time in next year, Fed will get into this comfort zone of that inflation is normalized and they will cut rates. It's just that yesterday the messaging was so dovish that the markets are becoming a lot more confident, and which is why we have seen yields rallying by another 15 to 25 basis points between yesterday and today. But large part of the move, as you rightly said, markets are already pricing in. The job of the market is to preempt policymakers, which they are doing as of now. The policymakers have finally given up, like what markets gave up in 2022, when markets were not sure of that rates will remain higher for longer, but Fed clearly convinced market that rates will remain higher for longer. This time markets were pricing that Fed will eventually ease. This time Fed has given, rather policymaker has given, that they are now eyeing for soft landing, and which means that they will cut rates in line with markets. They are pricing too much of rate cuts. Markets are pricing 5 rate cuts by Fed in 2024. Fed is getting 3. If we look at a growth inflation rate in the US, we think that Fed will give up and they will actually cut somewhere between what markets are pricing in or what Fed is pricing in.
Fantastic. And there is a new fund which we know from Birla, where if you want to bet on the downtick, well, you can go and subscribe. It's a very nicely timed fund, I must say. That's also lovely to have you on ET Now. Thank you for joining us. I'm just going to turn to my right. Kunal Bothra. Hello. Kya baat kare?
This is just a start and a continuation of a rally which we've seen.
Okay, let's go back last Friday. Or let's go back to the time when the rally really started post the election verdict. That's about good 8 days now.
Correct.
In the 8 days, what has changed for the market? Which to your mind is a long-term trend in changing?
So in terms of sectors, if you ask me, Nikunj, I think there's a decisive tilt towards large caps, which has been seen. So, in the last so many different textures of the rally, we were always seeing that the mid caps and small caps were outshining, outclassing and outperforming the large caps by a huge margin. But this time around, the biggest change which you're seeing is that large caps are trying to make a comeback again or have at par performance with the mid caps and small caps. The mid caps and small caps would have an edge because of the high beta nature of the stocks and the basket as such, but the large caps are not grossly underperforming. So that's the more decisive change which happened. The second and the most important part is not just the large caps, but even the underperforming sectors. For example, the metals, it was a huge underperforming sector. Chemicals was a major underperforming sector. Many of these underperforming sectors are also making a strong comeback for themselves. So I think this tells you that when all parts of the wheels are moving, it indicates that it's not just a short-term trajectory or a trend which we are looking at. We are talking of possibly a major multi-month or a multi-quarter uptrend for the indices.
Okay, so if one is purely looking at today's gap up start, 200-point gap up start, should one wait for a decline or today just ride the gap up start? Because if you, let's say, bought on Monday, post the election verdict which happened on Sunday, even though Nifty had a gap up start of 200 points, you actually made another 500 points after
Correct.
that. So based on today's rally, let's say 70,500, I mean,
on the Sensex.
Yeah, and 47,800 on the Nifty.
On
we are only 200 points higher than the day's gap start. Time to buy now also, or just wait for a bad Monday or a bad Tuesday?
No, I think wait for a bad Monday or a bad Tuesday, because I look at this one, in this last 2,000 plus point rally, we have 8 gaps on the index which have been unfilled. Now, we can always say that yes, these gaps are always good for the markets because it tends to take the index higher to a next tangent altogether. But then, every time when you see a gap, there's bound to be a process of a gap filling. Just like what we saw, I think 2-3 days back when the index came down 200, 250 odd points. Try and take advantage of those corrections.
So mind the gap.
Mind the gaps, yes.
London Tube ke baar likha rehta hai.
Correct.
Mind the gap.
Correct.
That gap has to get filled.
That gap has to fill.
So Kunal is saying that, look guys, don't chase. You want to wait for a bad day and then buy. But buy. Correct. Don't wait more if you get a bad day. Because you may not get 2 bad days together, you may not get 3 bad days together. When you get 1 bad day, a little bit of shakeout, go and just buy. That's what Kunal seems to be indicating. All right, let's take a break. When we come back, stock-specific queries. We'll connect with you. Sanjeev Basin is getting ready. He just finished his lunch, just texted me, and he's getting ready to answer all your questions. Let's say hello and good afternoon to Sanjeev Basin. And our first query is on Z Entertainment. We're at 307, have been holding the stock for 3 years. That's coming from Jojo Thomas from Kerala. Now, Basin saab, just a coincidence. हम सभी भी Z की बात कर रहे थे. Now, there is an event risk in Z. How should one approach a stock where there is an event risk?
Yeah, good afternoon. Nikunj, I think the event risk is very marginal because we know that Sony is very keen on increasing its stake. It has already categorically passed a resolution that their biggest market is going to be India. And it's just a matter of time. Now, we know that with 3% stake, the Goenkas have held not only the equity holders, but all the debt holders and the rest to ransom. And I think this will good riddance to bad rubbish as soon as it happens. Please stay put. This stock can be a doubler from here if you have a 2-year vision. If you have sat for 3 years, the next 2 years you will double your money. So stay put with Z.
Stay put with Z. Of course, Basin Saab feels that the event risk in Z is something which can be ignored actually. And just think about it. I mean, there is a massive consolidation happening in the India media sector. And at a time when, the franchise is growing, media inflation is coming back, Basin Saab feels that may just be a great idea to stay there. The second query is coming on Jio Financial Services. Is it better to invest in newly listed companies like Jio Financial Services or stick to established NBFCs like Sundaram Finance for a duration of 2 to 3 years? That's again coming from Kerala. So viewers are watching our show in Kerala. Thank you very much for that. That's coming from Satyan. Basin Saab, I'm just discussing a theme with you. Sundaram Finance has got years and years of growth. They manage crisis. They don't dilute. and it's compared to almost like gold in Kerala. Sona and Sundaram Finance stock, it's weighed in same thing. Jio Financial, high tech, new tech, comes from the halves of Reliance, market cap of 1,50,000 crore, but is still not making money. It's a difficult choice. Go for a well-established, fantastically run NBFC, or go for Jio, which is a promise on technology and a promise on spread and reach.
So go half-half, because you are investing in a proven franchise of Sundaram, which has been, a class outperformer. But you are also investing in the largest market cap in India in a group, and where the conglomerate is now looking at technology and fintech and co-lending as a very big source. And they are putting all their money where their mouth is with Blackstone and others. So pedigree, business outlook, profitability will take time, but 2 years, it could be a very, very sweet outperformer and a good holding in your portfolio. So 50-50 for both.
But if you have to make it 60-40 then?
Yes, 60-40 will also do.
No, 60 कौन सा 10 ज़्यादा किसका?
60 मैं जाऊंगा Sundaram के साथ, 40 with Reliance.
Okay. Where do you think the stock of Sundaram could move in next 3 years?
So we can see pedigree stocks, pedigree businesses are doing well, and the growth in India is more in the mid-tier and SME market. And Sundaram is a class outperformer with a very, very strong franchise and brand. So I think both those stocks can give you 50% upside, and I would not be surprised if Sundaram even beats that 50% by more.
Next query, and we're getting a lot of queries on PSUs now. There was a time when we had stopped getting queries on PSUs. Whether it is SAIL or PNB, two very differentiated stocks. Can I invest in SAIL or PNB for the short term? I want to put in 50,000 rupees in a stock. It's coming from KBS Bala Subramaniam from Hyderabad. KBS, thank you very much for that question. Now, SAIL and PNB, Basin Saab, they have only one thing in common. They both are owned by Government of India, but nothing in common apart from that.
Correct. But PNB has been a class outperformer from those 35-40 levels. It has hit 90 today. I still think it trades at less than 1 time price to book, but a large part of the rally is already built in. Good bond yields, good management by in the shape of Mr. Goyal, all are taking place, and their recovery process is very strong. So I would suggest a PSU nahi, but I would suggest a private bank like an ICICI or Kotak. I think that has more room for upside. And I would go with SAIL. I think SAIL has just broken out, and SAIL has languished for the last 2 years. Nikunj, I think SAIL is headed to 150. Given that it is the largest exporter, and I think that is adding to their margins, this quarter results will be very, very stark. And we think steel prices on the back of a weaker dollar will definitely do well.
Is it a better idea to look at SAIL or JSW Steel, which frankly is a better cost producer and has higher efficiency?
Yes, I would go. So buy a basket, buy JSW, buy Tata Steel and SAIL. Spread your risk in 3. But since you are keen on SAIL, add it.
What should be the split of 50,000 rupees? Put 15,000 in each 3 stocks, SAIL, JSW, and then go for, essentially PNB.
PNB and spread it in 4 tranches. SAIL, JSW, PNB and Kotak Bank. You will have a very good mix of 12,500 of all 4.
Now, understand that with SAIL, there is a cycle at play. With banks also, there is a cycle at play. If China comes back next year, the steel cycle could be very different. Economy is prospering and PNB balance sheets have, is better and much leaner. So things in the short term for PNB will also do better. And please remember, bond yields globally have peaked out. Locally, they will also peak out, which means that for next coming quarter, the M2M gains, at least for some of the oil market, for some of the banks, I think are likely to surprise us on the upside. So thank you very much for sending that query, and thank you very much for watching the show. Markets, well, as we speak, it's another dream day. Just word from the word go, good gap up start, and then really a lift off from there. I think it's almost pushed the markets to the highest point of the day.